Hello and welcome. You're watching Business Today TV. I'm Sakshi Patra and this is Market Today, a show where we'll help you understand the closing action on the D Street, starting from the benchmark index moves to sectoral action and all the stocks that are buzzing the most in trade. We'll get you expert views to find out where exactly should you be putting in money as far as the markets go and where will you really make maximum profits. All of that coming up, but do stay tuned for all of that. First up, a quick check on how the markets are doing, especially the benchmarks, the Nifty and the Sensex at this point in time. A 66 point of a cut on the Nifty right now. It's again slipped lower. 19,674 can be seen on the Nifty. The Sensex is now hovering around 66,000 odd levels. It's now down by 222 points, 0.3% cut for both these major indices. What is really pulling the markets lower in trade? Well, a whole host of sectors have now slipped into the red. Pressure coming in on the Nifty Bank right now, especially when it comes to losses from the private banks and from the financial services space as well. That's now slipped 0.4% lower, and that is one of the biggest drags on the markets right now. Apart from this, we also see several other sectors lower in trade, the IT, the metals, oil and gas. You're also seeing the mid-caps now slip into the red as well. So among the broader markets, it's the mid-cap space that's now slipped into the red, and that's also creating some pressure. Flattish to positive bias on the small caps index right now as we speak. On the names that are dragging down the markets lower in trade, you can see a lot of heavyweight counters on the Nifty. Now dragging the Adani Group stocks have fallen in trade as well. You have Bajaj Finance and Bajaj Finserv. Definitely the heavyweight counters creating some bit of pressure. Ultratech Cement, HDFC Bank now lower by 1.4% at 1531. Again, another day of losses coming in for HDFC Bank. Dr. Reddy's, Cipla, Wipro, these are the other drags at this point in time. What's holding up into the markets? Well, it's Axis Bank, Asian Paints, Coal India, Grasim Industries. These are the stocks that are still holding up in trade right now. Of course, it's the PSU Banking Index sectorally that is still doing well. 3.5% of a move can be seen on this one. It's bucking the trend despite the overall muted trend in the markets right here. Autos and the small caps, the other movers at this point. But let's welcome our guest on the show. Sunil Damania now joins in. He's the Chief Investment Officer at Markets Mojo. Welcome, Mr. Damania, and thank you so much for taking the time out for this discussion. First up, a quick take on the markets first. What does the current setup really tell you about the markets? We've recently seen the all-time high levels, 20,000 milestone on the markets. Beyond that, there has been some kind of profits being taken off the table. The global setup is throwing us some numbers, crude oil prices rising. The hawkish tone of the Federal Reserve returning as well. And now we have the geopolitical tensions as well to put some speed bumps right there. Are you worried about any of them or all of them? And what is your own sense about the market strategy right now?
Good afternoon, Sakshi. I think the volatility is a part of the market behavior. So, market did extremely well from April till August. And it was very expected in the beginning of our September. We did put out a note saying that we should expect corrections in the market. And not only that, we also said that there will be a sector rotation that will take place. And we also stated that mid and small cap, which did extremely well, will see some kind of a profit booking that is happening. So it's a part and parcel. If you look at historically, September normally is one of the weakest month for the market. And if you go back to the last one decade, you would see only two times Nifty and Sensex close in the green for the month of September. But September also gives a good opportunity for investors to buy more at the lower valuation, because normally market does extremely well October to Feb period, and something similar that we are expecting. Now, you did mention about some of the concerns about hawkish view from the Fed. You did mention about geopolitical conditions. You did mention about crude oil. I think let's start with the FOMC meeting yesterday. Not only the FOMC, not yesterday, day before yesterday, FOMC as well as the Bank of England, they decided to keep rate at the same level. Yeah. If you look at the CAB Fed Watch tool, they clearly said that there's a 30-35% probability that we could see a 25 bips rate hike either on 1st November or on 13th December. So there should be one more rate hike. But I don't think the market is going to get little jittery about now Fed rate hike, because eventually everyone is basically budgeting for a rate cut in 2024, and market normally try to discount in future. So I don't think that's a concern. Crude oil is a concern, definitely is a concern, for the very simple reason because it could stock inflation. And that's one thing which it's not only stock inflation, it can also put a brake on possible rate cut from the RBI. Why? Because RBI will not be comfortable if the real rate go down as compared to the inflation. So that's a one concern we need to keep wait and watch, and then we'll get more clarity on that. And as far as geopolitical concern is concerned, I don't think that's a major concern to be really worried about. I think people will not talk about this geopolitical condition, tension between India and the Canada in next 6 to 7 days. I think it is just a small glitch kind of a stuff. So in nutshell, I think market is giving a very good opportunity from this level to buy more and make a beautiful portfolio.
Okay, understood that. Let's also talk about a few pockets then and your views over there. First up, let's talk about the banking space. PSU Banks rallying like, there is no stopping, and none of the hurdles can really stop the kind of rally that we've been seeing. PSU Banking Index has been rallying for this last 12 months odd or so. It's rallied 61% as against 12% surge on the Nifty or a 10% surge on the Nifty Bank. So widely outperforming the Nifty Bank and the peers, and of course the markets as well. What is your sense of what is pulling the index higher and these PSU banks right now? And despite such a strong run up, is there still value in the PSU banking space?
So, those who are in the market from last 1 decade or so, you would have seen a huge divergence between the bank Nifty and the PSU index, PSU bank index. This is the first time we are seeing PSU bank is outperforming significantly to the bank Nifty. If you look at bank Nifty, it would be up by 4-5% YTD, which has also underperformed the large cap, that is Nifty and Sensex. But as you rightly said, PSU bank index is up by 20% or so, which normally we don't see that. Now, our view is right now very clear cut that there are certain pockets within the. So PSU bank, normally people brush it with the same pen, like the same this one, that everyone is at the same bucket. We should not do that. There are certain banks which are doing reasonably well because they have a good ROA on their books. Their NPL levels are coming down, and their overall CASA deposit ratio is quite healthy. I think those banks can still offer some kind of a capital appreciation to the investors. But the rest of them, I think they would definitely struggle to give capital appreciation. So our sense, if I have to really look at PSU Bank as an index, I think all good things are there in the price. From this level, it has to generate alpha, looks little difficult, which I was saying in opening remark, there will be sector rotation, and that sector rotation could also apply to the PSU bank. So maybe at this point of time, you are making a good money, and the bank which you have invested having a poor ROA or the NPAs are going up, I would rather prefer to book profit rather than putting more money into the PSU bank.
Okay. Apart from the banking space, say in case the markets were to correct a little bit more, which makes the overall prices even more attractive, what would you really add into your shopping basket?
So, okay, what we are doing on our PMS, as you know that we started our PMS service, what we are basically concentrating more on the mid and small cap space. And within that, we like pharma because we believe the pharma should do reasonably well. We like metals. A lot of bad things, a lot of negatives are already there in the price. From this, the risk versus reward definitely goes in the favor of reward. We like some of the paper companies because we believe that the paper cycle, the price which has came down substantially, have started moving up, and that one could see some kind of a better numbers coming out for the quarter ended September. Some of the chemical companies are also looking little attractive purely because of the risk reward ratio. Because chemical companies have seen huge erosion in the price in the sale price in last 9 to 12 months, and due to that, and now chemical cycle seems to be giving some hope that it can now start inching up, and if that happens, the chemical companies' profitability will also improve. So we see these are the pockets where one can definitely put more money in case if market gives an opportunity in terms of corrections.
Okay, understood that. Since you talked about the mid and the small cap space, I also wanted to understand, there has been a dichotomy of the views that we have been getting. There are views that suggest that perhaps the mid and the small caps, there is a lot of euphoria building up, or, valuation bubble is now kind of getting created. How would you really advise investors who've been sitting on handsome profits? Because from the lowest level this year, both the mid cap and the small cap 100 indices are up nearly 40-50% odd. What would you suggest investors to do really? What is the right strategy to have?
So, if you remember in the first show that which I appeared for BT, that was in January 2023. At that time, everyone was bearish about mid and small cap, and we suggested please go ahead and invest in mid and small cap. And you look at it, mid and small cap significantly outperform the large cap. So we are not in that. We are or normally we take a contra view on the market. Now you use the word bubble. I'm a little surprised with that terminology because yes, there will be some pockets which will always happen in any market. There will be some pockets where there could be a bubble within the mid and small cap space. But if you look at the overall market cap, and the beauty in the market is that how you look at the numbers. If you look at the numbers of mid and small cap as a percentage of total market cap, mid and small cap still accounts for very maybe 6 to 7% of the total market cap. Logically, they should command 12 to 13% of the total market cap. So still there is a huge room foreign capital appreciation. Now we all suffer from recency bias. That's a behavioral finance issue.
Yeah.
Where the last 1 week, I think median small cap came under heavy pressure. But if you look at 1 month, median small cap still outperformed the large cap. So even despite underperformance even last 1 week, we believe that there is a so we strongly believe median small cap will outperform very significantly. I think there is a huge opportunity for them. And see, remember that when the rate of interest starts coming down, which eventually will start, it will benefit more mid and small cap companies. Why? Because they have a more tendency to fight on when the rate of interest goes up, their ability to take on the large players goes down. Why? Because their credit history is not so great and hence their cost of borrowing goes up. If you happen to listen to some of the commentary given by FMCG player like Nestle or Hindustan Unilever, they are saying that some of the small players now giving a tough competition on them. Why? Because the input costs, which were very high, now it's making a comeback, and so they are able not. So they are taking away some market share from some of the established players. If that's so, I think we see a huge opportunity for mid and small cap to outperform. So there's no reason to worry. Even if you look at the valuations, okay, let's look at one of the other reason why valuation. If you look at the valuations of mid and small cap, we are definitely not in a bubble zone. Of course, we are little above the 10 years average. I agree with that. But there is no way to say that we are in a bubble zone. And if you look at the flow that is coming from the mutual fund schemes, more and more flow is going to the mid and small cap. Now, if there is a more liquidity, fund manager can take a cash call, but how long will it keep taking a cash call? Because a lot of money is coming through SIP, which is not going to stop. It's there in 1 month, not there in next month. So that liquidity will also ensure that the mid and small cap, for any reason there is a correction, more buying would come from the domestic institutional investors to buy in. So we don't see any downside risk much to the mid and small cap. It makes a lot of sense to get into mid and small. Of course, probably you need to be a little selective in terms of your stock selection.
Okay, understood that too. But is there any pocket, Mr. Damania, that you would like to, beware investors of, where you believe that, a lot of, overheating is taking place at this point in time? Would it be the likes of, say, defense or PSUs or railways? These pockets have really had a very, very sharp rally in a short time.
So one pocket definitely we discuss about PSU Bank, where I would like to lock in some of the profits if at all someone has an exposure. We believe so. We do own defense stocks in our portfolio. We do own railway stocks in our portfolio, and we are not in a rush to move out of that. We believe it's more of a structural story that's going to play out, and hence we should not be little quick to get out of those companies because they are structural in a very, very good zone actually. So the rally is just started. In fact, the party is just party to be shuru hui usme. So I don't think we need to be little worry about it. Of course, there'll be some corrections because that's the way the market behaves. No company can keep moving up in a straight line direction. So, but that is the nature of the market. But I don't think they are in a bubble zone that we should be little worry about it. In fact, defense and a railway is a theme that's going to play out for next 3 to 4 years. The kind of rally that we see from 2003 to 2007 for the infra stocks, some similar rally will play out in the railway and defense for next 3 to 4 years.
Okay, understood. Well, many thanks, Mr. Damania, for being with us on the show and discussing all these pockets with us and for all our viewers as well, and sharing with them where exactly should they be keeping their focus right now in this otherwise slightly nervous market. 70 points lower for the Nifty right now, 19,669. So looks like we are going to be headed for the worst week for the Nifty in 7 months, but definitely still a lot of pockets where money can continue to be made. So keep an eye out on all of those updates as well, and we will continue to share them all through the trading session with you. What you should also get ready is for our special series, that's Market Masters, coming up on the Monday, that's 25th of September, where Saurabh Mukherjee will be joining us, and he will be sharing the investment strategies, insights, market analysis. He's the founder and CEO of Marcellus Investment Managers, and you can send us your queries that you'd like to point to Saurabh Mukherjee on the number that's flashing on your screens. This is a WhatsApp number 730-308-0488, and these questions will be taken live.